Hello, Steve Lentz here with Discover Options. Welcome to this edition of the Market Reports. This is for Friday ending on March 10th, getting ready for the open on March 13th. We have two reports for you today. The S&P 500 Condor Butterfly Timing Report for those of you that use technical analysis to assist you in the entry of your Condor and Butterfly strategies as advanced options traders. For those of you more statistically oriented, we have the S&P 500 Directional Likelihood Report showing you, based upon the current pattern of the market, what the likelihood is that the market will go up, down, or wobble around a little bit. And we'll get to both of these reports in just a second. Want to remind you that you can get a free e-trading book by clicking on the link. And filling out the information, we will get you the simple steps to options trading success. That's free. Also, if you could please subscribe to our channel, we would certainly appreciate that as well. Let's go to the current market condition. It's defined in the following manner in terms of price action. Thursday was a downswing day, lower highs, lower lows. Friday was an upswing day, and that occurred all when the trend is positive. It's up, bullish. The price is above the 50-day simple moving average. However, in the stochastic, the overbought oversold indicator, the 15-3 stochastic, we are between 30 and 70. And the stochastic is underneath its 3-day simple moving average. So all that makes for a market condition that is fairly unique. It's only occurred roughly 65 times since January of 2000. January of 2000. Not too often, but that's the pattern we're going to look at. It's a unique market condition. And so let's go and take a look at the Condor Butterfly Timing Report. When you look at this condition, as you'll see here, it says it's occurred 64 times. Here's the narrative here. All right, there's so far, since Jan of 2000, there's been roughly 4,300 daily closes of the SPX. All right, now of those, 64.8 have been percent have been favorable bars for selling premium, where the actual 21 bar movement was less than the SIBO SKEW adjusted implied movement. All right, so 64.8% of the bars have been favorable for doing butters and condors. Also during that time, the current market condition I just showed you has occurred 64 times. Of those, look at this, only 51.6% of the bars have been similarly favorable for selling premium, option premium in a neutral fashion like that. That implies that we have a negative edge right now. There's a baseline edge. You could flip a coin in the market, and 64.8% of the time, you'll end up getting a bar that's favorable for doing butters and condors. Our current pattern that we have going on right now, okay, only 50, of those 64 times that it's occurred, just barely over half of those have been favorable for selling premium neutrally. Almost half of the time, it turns out that the market moves more than what the options are implying. So statistically, it's more likely than usual that Friday's bar will end up being unfavorable for market neutral option premium selling. Okay, so that's where we're at. If you are really looking at this as a way to help you enter your butters and condors, you should be just a bit more nervous about the future than normal. All right, now let's look at the likelihood report. Now for those of you brand new, we're gonna go into the methodology here. We explain it the same way every time, but for those of you veterans, would certainly understand if you would just watch the results here and then go on your way. But here we go. We have the market likelihood report. We've got the, now these are trading bands, statistical volatility determining the width of the bands from the close. The question is, how often does the market hit these bands? Okay, now, so on a benchmark, the historical distribution at the top is showing us that the upper 5-day volatility band is struck 29.6% of the time. The upper 10-day band, 23.4. The upper 15-day band, 23.4%. The lower bands are struck 29.4, 29, and 31.8. That's the benchmark. Now, of our 65 occurrences of our current market condition, all right, the upper bands, look at this, are struck 21.5, 18.5, 23.1. Okay, less than the benchmark. So this is a picture that the upper bands are not struck as often as normal. Lower volatility on the upside after this condition occurs. Now on the downside bands, these bands, look at this, are struck a little bit more often. Okay, 32, 33, and 40%, which is more often. We have the blue. So this is a picture here of slight bearish bias. The upper bands are struck less often, and the lower bands are struck more often. Upper bands less often, the lower bands more often. That's a bearish bias right here. All right, now, what we do ask also is what happens when Friday's bar is exceeded to the upside. If it's exceeded to the upside, you could see, interestingly, the upper bands are struck less often, okay, than the benchmark. The lower bands are still struck more often, but not as much so as just the base 65. Now, if price exceeds the low of Friday's bar, look at this weird thing. Then the upper bands, in those 31 times, the upper bands get struck more often and the lower bands get struck more often as well. Interesting stuff, isn't it? All right, so what's this a picture of? The baseline 65 just at the close, it's painting a bearish picture. All right, but it's a more mixed picture when we have when we carve it up when price exceeds the high of Friday or goes down below the low of Friday. If it exceeds Friday's low, you have a picture of likely increased market volatility, either to the up or the downside. Okie dokie. So there you go. Those are the results of these reports. Let's dive into the methodology for those of you new that want to get right into this. All right. Oh, and by the way, let's go to the SKEW adjusted VIX. We also adjust the bandwidths using a SKEW adjusted VIX instead of statistical volatility. Let's just take a look at that real quick. Let's see here. So we have that. This is the SKEW adjusted VIX. You know, here you have much more of a mixed picture when the SKEW adjusted VIX is used. And you can see it's not quite so bearish in that particular case. If the market exceeds the high of Friday, the upper bands are getting struck less often, as are the lower bands. But if it goes down below the low, then you have slightly increased likelihood of volatility here. Much more mixed, though, using the VIX. Okie dokie. All right. Let's get to the methodology of that butterfly timing report for those of you trading premium neutrally. We'll examine why you should look at this, the methodology, and then the current level. So if the market begins to channel along and you're thinking about trading a butter or Condor, you know, it's not necessarily the case that a channeling market is going to continue to channel. Indeed, in this particular instance, when we did the analysis, the analysis showed that we had an edge, or excuse me, a negative edge for selling premium neutrally. Now, what does that mean? It says that there is a higher than usual likelihood that the market was going to be more volatile than what was implied by the option prices. And in this particular case, it turned out to be true. All right, so you want to pay attention to this stuff. Here's our current market condition, and the question on the table is this condition a good one for selling option premium through butters and condors, through range trading? Is this a good market condition to do that? That's a good question. How do you answer that? How do you answer the question, is it a good time to put a condor on or a butterfly on? How do you know? And so that's what we seek to answer through this methodology. First, we're going to observe how much the market moves from a given close. We call that actual volatility. Next, we observe what market move is predicted by the option prices, or implied volatility. We compare the two in hindsight. Okay, we go back and we label the bars either favorable or unfavorable for selling premium, and we record that and keep the statistics. So here's just an example of the actual move. You could take a close and you move forward 21 bars, and you ask yourself, how far did the market move, either up or down? What was the most that it moved in either direction? In this case, it went down 50 points, which works out to be about 2.4% of the original value of the index. So it moved down 2.4%. The question also is, what market move was being implied by the option prices at that time? And when you take a look at the SKEW adjusted VIX, it was implying a move of 4.4%. 4.4%. That is more than what the market actually did, isn't it? So that bar would have ended up being favorable for selling premium from a neutral perspective, okay? Would have been favorable, and what we would do is paint the bar blue so that all the blue bars in the past were favorable. They ended up, in hindsight, being favorable. The red ones, in hindsight, 2020, ended up being unfavorable, meaning the market moved more than what the options were implying. So we can go back in time and now start measuring some of this and looking at market conditions which are more likely to produce blue bars than red. That's what we're all about here. So the question, to get to this further, we're going to first have to ask ourselves, what percentage of all the bars going back were favorable for doing butters and condors? Okay, all right. Of those bars, and then once we know that benchmark, we ask ourselves, of the bars that match our current market condition, okay, there's about 65 of them going back. What percentage of those were historically favorable for selling premium? The difference might represent an edge we can have. So when you go back over 4,000, about 4,300 closes going back to Jan of 2000, you discover that about 64.8% of the bars ended up being blue, favorable. Okay, 34 point, is it 34? No, it should be 35. I'm sorry. You know what? Let me just go in there. 35. Okay, 0.2% ended up being unfavorable bars. So that's the benchmark. That's the benchmark. Now, what if we find out that our current condition had it such that all of them were favorable? Every time our current market condition occurred in the past ended up being favorable. Well, you'd be more aggressive about trading butters and condors, wouldn't you? What if you found out that all 65 of those signals going back ended up being unfavorable, red bars? Well, then you'd stay away from butters and condors, wouldn't you? So what we're doing, though, is we're going to look at that. Of the bars that match our current condition, what percentage of those were favorable for selling premium? We discover that just barely half of them ended up being favorable for selling premium neutrally. This means we have a negative edge. You could flip a coin, and 64.8% of the time, you'll get a favorable bar in the market. Okay? Of our market conditions that we currently, of our market, for our current market condition, when you go back in time, 65 of the, it occurred 65 times, just barely half of those ended up being favorable. So right now, we have a negative edge here. There's a higher than usual likelihood that the market will be more volatile than what is currently implied by the option prices. Got that? So that's how we get to this figure of a negative edge in the Condor Butterfly Timing Report. Before I go to the likelihood report, folks, please check out our website at DiscoverOptions.com. Look at our curriculum. We have an outstanding array of courses for you to take to get you from a beginning intermediate level up to an advanced options trader. You could be a money manager yourself if you want. Our mentors manage money themselves. They were in the pits, in the options exchanges when they started out years and years ago, and we really have guys that know what they're doing. So you want to check out the curriculum and get involved in this. Have someone hold your hand, walk you through the process of learning how to successfully trade options. Okay, because you can get burned, and you need someone looking over your shoulder to make sure that you manage your risk well. That's what we specialize in here, is a curriculum that involves one-on-one mentoring to help you get where you want to go in as quick a fashion as possible. Let's go to the likelihood report, and I'm going to show you the methodology here. And the question on the table here is, since Jan of 2000, how often has this same unique condition occurred? We know around 65. And what did the market do in terms of direction and volatility when this condition occurred in the past? Okay, let's do that study. It's a little bit different than what you're used to. So here's what we do. We want to know, after this condition occurred, did the market go up, down, or do nothing? And how do you measure whether it had a bullish bias or a bearish bias? Okay, because if certain technical analysis systems work, you would assume that there would be a bias to the upside, the downside, if it was truly predictive. So we're going to take this current condition and just see if there's a bias to it, bullish or bearish bias from this condition. How do we determine that? Well, we're going to look at price distribution. We're going to understand the historical distribution of price in general, and then we're going to look at the price distribution after our specific condition developed. Then we'll determine if there's an edge or not. How do we determine distribution of price? What we do is we use volatility bands set from each bar's close, set 5, 10, and 15 days to the upside, using a 20-day historical volatility measurement. And we also do the lower 5, 10, and 15-day bands from the close each day, using a 20-day historical vol number. And these are log-normally distributed. Here's an example of a 10-day volatility band. We have a 10-day volatility band here. The question is, did the market go up and hit the upper, the lower, or wobble around and do nothing and stay in the middle? Okay, in this case, the market clearly went up and hit the upper band. So that's what we record for that particular close. Now let's take a look at this close. Here's the 10-day band to the upside, 10-day band to the downside. Did the market go up and hit the upper, go down and hit the lower, or wobble around and not hit either of them? In this case, the market tried to hit the lower band right there, but it failed to. So for that close, we record that it hit neither band. And so for every close, we record whether price struck the upper or the lower 5, 10, and 15-day bands. And then we record that, and here it is. From Jan of 2000 through March 10th of 2017, there's been almost 4,300 closes. Amongst those closes, price struck the upper band almost 30% of the time, the upper 10-day band almost 23.5%, the upper 15-day band 23.5% almost. It struck the lower 5-day band 29.4%, lower 10 29, and the lower 15 31.8. So that's the distribution of price amongst all the closes going back, moving forward 5, 10, and 15 days. A lot of the time it doesn't hit either band. It just wobbles around and hits neither band. Do you see that? Okay, so with that in mind, now let's go move on, and now we're going to look at the distribution after our condition develops. So our condition doesn't occur that often, 64 times, going back to Jan of 2000. We're going to look at the distribution, though, as of the close. Also, what happens if price goes above Friday's high? What happens if price goes below Friday's low? What's the distribution then? That way, you'll have an idea on what to expect on Monday if price exceeds Friday's high or low. So here we go. Okay, as of Friday's close, that occurred. We have 65 occurrences. Okay, price struck the upper bands less often. Okay, after this, amongst these 65, price struck the upper 5-day band only 8% of the time, or excuse me, no, 21.5% of the time, a lot less than 29.6, 8% difference. It struck the upper 10-day band 18.5% of the time, the upper 15, 23 points. So these are numbers are lower than the benchmark. Okay, so they're striking the upper bands less often. Doesn't mean they never will. Look at that. I mean, they hit the 5 and the 10 roughly one time in 5. Okay, but that's less often than the benchmark. Now, when we go to the lower bands, price struck the lower bands a little bit more than the benchmark. Do you see that? So this is a picture of a bearish bias. Does it mean the market is going to go down? No, but it means that there's a greater likelihood that it will, a greater likelihood than normal. It could still go up. It went up and hit the upper bands one time in 5. But it also went down and struck the lower bands more often. Do you see that? So there's definitely a bearish bias to this setup, the current market condition. Now, if price exceeds Friday's high, we can see that the upper bands are then getting struck less often still. The lower bands are getting struck roughly the same, very, very close, very, very close. Okay, so this is a picture more definitely of less market volatility in general if price exceeds the high. Now, if it exceeds the low from Friday, the lower bands are getting struck slightly more often, quite a bit more in the case of the 15-day band. Okay, the upper bands are getting struck. So in other words, if the market goes down and goes below the low, then look out above, because it could rebound, and in that case it's happened that the market is then blasted off and gone up and hit those upper bands. It's hit the lower bands also. 2 of the 3 have been struck more often. So if it goes down below Friday's low, we can expect a likelihood, there's a greater likelihood for more market volatility then. Okay, now we like to cast these bands in the context of a skew adjusted VIX, where the bands are wider apart than using statistical volatility. The VIX is typically higher than statistical volatility, and then that puts the bands farther away so that they are then getting struck less often in our benchmark reading here. Okay, they're also skew adjusted, so the lower bands are farther away from the close than the upper bands. Okay, because the out-of-the-money puts are priced higher than the out-of-the-money calls, so we skew the bands in accordance with that market bias. Okie dokie. Now, in this particular case, you can see more of a mix-up in these. We have the, as of the close, all right, we have really, these differences are somewhat but not as profound as using statistical volatility, where the bands are getting struck roughly the same amount. You know, a little bit of difference here in a couple. In the upper, the less often, 15, about the same. The lower is pretty much the same. Okay, so much more of a mishmash. In terms of if price goes above the high, the bands are getting struck far less often. Look at this, much greater likelihood of a lower market volatility. And if the price goes below the low of Friday, you have again more market volatility is what the likelihood is here. But again, you have a mix-up. I would also mention too, 65 isn't the highest value. It'd be great if it was 100 to 200. All right, it's just that we do have a fairly rare market condition right now. Okay, folks, in terms of a trade idea, because we have such a negative edge in terms of selling premium, I decided we would not set that or give one out, because we had this negative edge going on here in the Condor butterfly timing report. We'll just take a pass right now because of this huge negative edge that's staring right at us. Okie dokie. Folks, thanks so much for joining us. I'm Steve Lentz with Discover Options. We'll be back next week. Same bat time, same bat channel. Take care. Bye-bye.